I'm Tim Scheib with Remax Precision, and I am with Eric Sanders. He is a mortgage coach with Fidelity Bank here in Des Moines, Iowa. Tell me a little bit about yourself and what you do.
Well, I've been in the mortgage business for 30 years, and I've moved to Iowa just about a year ago. And, I call myself a real estate coach because lending is just one aspect of the whole thing. And after doing this for 30 years, I really think that in order to get net wealth accumulation, real estate is one of the best ways you can do it. And I don't think that there's a lot of people out there really as proponents of that. Buying your first home, buying your second home, all those things. But real net worth is built mostly for the average Joe through real estate.
So one of the things that is blindly obvious to everybody across this country right now is affordability in homes, and should they buy homes today, and if so, how can they get to that point? I know we first started talking because we had the same viewpoint of it's possible. You just got to put a plan in place. So right now, what is like, if I were coming to you and I'm like, I just can't afford a home, where's the first place you would start?
Well, I think the first thing is understand that it's good to do. It's good to buy a home, even with high interest rates, even with affordability going in a negative direction. You need to get in order to get up. And we need to create a plan to do that. And if you don't have a plan, most people don't understand, like, well, I don't want to pay this, I don't want to pay that. But it's really not about that. It's about how do we get from here to there? It's a lot of creative and cognitive dissonance with customers about what do you need and how can you get it? Because there is a lot of help out there. It's just a matter of they don't understand until they talk to you or me, who are real estate professionals, to help them get into that first house.
So I'm a young person, never bought a home, and I come to you and I say, I want to buy a house, but I can't afford it. Now, as a real estate coach, would you come and say to me, like, what are your expenses right now?
Well, yeah, exactly. It's not about can you, it's when will you. Yeah. So we're going to create a plan, whether that's budgeting, debt consolidation, or whatever it is. I don't believe that people can't buy real estate. It's just a matter of they haven't thought of what avenues to take in order to get there.
And the sacrifices it takes. I think in our world right now, we have become so accustomed to the finer things in life. I look back in the 50s, right? Grandparents were buying a home. How could they afford a home on their salary, which was, $5,000 a year or $8,000 a year? How could they afford a home? And I think to myself, well, they didn't have the internet. They didn't have smartphones. They didn't have all the luxuries that we have all become so used to that it's actually just part of your life that costs a lot of money. So digging into that financial world and saying, hey, we can get there. Right. You just got to give up some of this stuff.
Right, and giving the carrot of why you should give those up. Because when you look at appreciation levels just for the last 80 years, it's unprecedented from any investment that you could possibly make, that real estate's the way to go. But I don't think the general public really understands that. The media comes out and says, well, real estate went up 6%, stock market went up 12%, so the stock market's a better investment. But you didn't invest the whole amount of money to buy that home, and the whole home is what's appreciating. So if you put $5,000 down on a $100,000 purchase, you get appreciation on $100,000, not just the $5,000 you put down.
And I think that's something a lot of people really miss, because you might say that my home grew by 20%, but what you don't understand is 20% of that $100,000 that's a huge gain on your $5,000, like massive. But then you have to roll back in your costs. So over the 10 years, you might have actually put in $30,000 because you put a new roof on, siding, windows, maybe redid the kitchen, did some flooring. So there's a lot of things. When I look at thinking personally, I sell real estate. I think it's a great idea to buy a home. When I look at it from the perspective of a buyer, because that's one of the things I've always tried to do is put myself in their shoes. Over the course of time, there is a lot of money that gets put into the house that sometimes also isn't recognized. Does it make sense to buy a home, have those expenses throughout, pay the interest, and hope that it goes up?
Well, absolutely. I don't think there's any question. In the last 80 years, real estate has gone down 7 years. And 5 of those years was during the mortgage meltdown, the housing bubble bursting. And that was because of inventory being too high. Right now, we're in a 180-degree situation where inventories are very low. Prices are going up, but prices don't cause bubbles. So the propensity for real estate to increase is 90%, even when you take in all the bad
inevitable.
years.
It's going to happen.
And when you talk about costs of doing a roof and things like that, when you look at the stock market over a 10-year period, with their compounding interest, you get about a 169% return on investment over 10 years. And in real estate, it's about 400%. So those costs are very small, comparatively speaking, to your cash-on-cash investment.
Yep.
It's not even a close race.
I mean, you look at it, and all the wealthiest people in the world own a ton of real estate for a reason.
Exactly.
And I've got quite a few followers on TikTok and Instagram, and I'll post a video and I'll say something to the effect of, why you should buy a house. And I constantly get hit with the affordability thing. And we need the housing market to crash. We need prices to drop by 20 to 30%. What's your opinion on that?
Well, we may need that, but that's not going to happen. The reality situation is when we did get the crash in 2007, there was 4 million homes in inventory. Now there's 30 million more people, and there's less than 1 million homes for inventory. And you can't just make inventory. I mean,
You can, but it's more expensive.
it's a lot more expensive, and builders don't want to have the carrying costs when they're looking at double-digit interest rates for a spec home that might sit for 4 or 5 months. So the real issue is not about should we get lower prices? It's what do we have, and how do I get to participate so I can build net worth and equity, so I can get, the first house that you get may not be the one you want, but you're going to get the same equity position because you're already in the market. The longer you wait, the worse the affordability gets, even when interest rates go down.
Yep. So with affordability, I hear that complaint, but if I also hear someone say we need the market to drop by 20, 30%, am I wrong in thinking that if we have homes drop 20 and 30%, so that this person over here who can't afford a home today can afford a home, if that happens, our world's in a much bigger mess, and we're going to have a lot bigger problems that this person will probably get hit too and won't be able to afford a home because they just got their face slapped because they either lost their job or they just don't have the capabilities because our market took such a hit.
Well, if you look at what happened in the Des Moines area, 2008 to 2012, real estate prices went down 6.13%. So if you want to go down 20, 30%, that's a catastrophic economic meltdown that, it won't matter about can you buy, because most people won't have jobs or anything like that. You have to deal with what is. You can't say, I wish. Don't wish it were easier, wish you were better. Yep. And the way you get better is talking to professionals that will actually help you get there. Yep. It's not about can you right now. If you can, great. If you can't, we're going to get you a plan to do that. It may be 6 months, it may be a year, whatever it is. It's not a matter of if, it's a matter of when.
Absolutely. And that's something I keep trying to push and push and push. And I keep getting hit by people that, I know a lot of the people who do that are the no usernames. They don't back what they say, they just want to gripe. But I do also understand it is hard out there right now. I mean, I see some of these mortgage payments coming through at $3,000 for a young couple a month. Yeah. And I'm like, I could afford that, but I'd never want to spend that on a house. But that's what you have to spend at this point to buy a decent home. I did have a client. He just bought a house from me. It needs completely fixed up. And he's like, should I just keep it for a rental or should I turn around and sell it? Because he was planning on flipping it, but then he's like, well, would it be a good rental? And I'm like, those homes that are 1,000 square foot, built in the 50s, 2-car detached garage, they will always be a starter home. In 20 years from now, they will always be a starter home. And I did a video on this, you might have seen it. But that is such a great investment because there's always going to be a buyer pool for that. Right. Because it's going to, no matter what, so we have an affordability problem. That's still going to be the most affordable house, right, even if they go up. So, I mean, I definitely truly believe that buying a house is a great investment. As far as rentals, right? I don't have the right head for owning a rental property. I think about it all the time. I get worried someone else is trashing my house. You know, they say the big time investors say, we'll hire a manager. That way it's out of mind, out of sight. Haven't had good luck with that. I don't trust that. I'm almost too controlling for that. What do you say to someone who wants to invest in real estate, but they might have that personality that's kind of tough?
Well, it's about risk and reward. And I mean, when I see a lot of people that they want to rent their current home and buy another one, and there's a lot of emotion tied to that. And when they see somebody that's not treating that home that they've raised their young kids in and things, it's a tough deal. It's a lot easier to be a little bit detached if you buy like a condo or a townhome or something that does the upkeep for you, at least on the exterior. But single family at that low price point is, I think, that the best option that there is for an investment property. And like I said, investment properties are 400% return on investment, cash on cash over 10 years, and stock market is 169%. So, you know, where do you want to keep your money? And are you willing to take a little bit of that turmoil in order to make that bigger margin? Because the stock market has their risks too. Yeah. What if somebody, you know, we're probably headed to a recession. What's going to happen with your money that's in stocks? Yeah. Would you rather have it in real estate where you have somebody trashes it and you have to replace the carpet, but you still get your return on investment? Yeah. Because what people don't understand is when the stock market goes down 50%, it takes 100% return on investment to get back to zero, to where you were. That's not the same in real estate. It doesn't go down that much. Even when we saw it go down in Des Moines, it went down 6.13%. And in 3 years, you were back even. Yep. That's not the same in the stock market.
So as far as like the stock market goes, I understand how the stock market works. As far as real estate goes, I understand how the real estate market works. I'm 100% with you that the housing investment is probably the best investment because you do have a tangible item. And that's the scariest thing for me about the stock market is that it's not really a tangible item. Right. You know, businesses are that you invest in, but it's just up in the air. So I do like that. So I personally have invested in land because I have an attachment to that land, so I bought it. But I feel very comfortable with the land purchase, but I do own a townhome. So you hit the nail on the head when you said buy a townhome or something that you don't have to worry about the exterior and the yard, because as an owner of a property, you drive by it and check on it once in a while. When you see a yard go to crap, you know the rest of the house going to crap, and then all of a sudden you start sweating and you start having some of those issues. But
absolutely.
I do wish I could get more into that residential real estate world, but man, I just don't have the headspace for it. You get busy.
And it's everybody has their own things, but what I would say is real estate, if you're thinking about return on investment, there's not another place that you can get a better return. And the history bears it out. I mean, stocks go up and down.
Yep. And
individual companies come and go. You know, I mean, everybody's, well, Amazon's going to be here forever. Well, 15 years ago, they didn't even exist. So, and then with IBM, they're going to be, you know, the blue chip stock to be all stocks. Well, they're not. No. And so those things go up and down. In real estate,
it stays pretty
it's the same.
So let's talk more about affordability. The houses, they got there. The prices went up greatly. I made a comment the other day that I think you commented back to it was, I wish that the mortgage rates would have gone up at a slower pace and then stayed steady at a lower number, and then they would have just let inflation ride itself out.
Right.
Would that, now I'm playing Monday morning quarterback, I get it, but would that have been something that might have worked better?
Well, I think for sure. At the beginning of the year, that was February, March, the rates got down a little bit and we saw an influx of people into the market. So for sure, if rates were a little bit lower, more people will be in the market. The fact of the matter is, I think that the Federal Reserve is raising rates faster than normal because they tend not to want to raise rates in an election year. They want to be hands-off and neutral. So I think they're kind of doing it faster than they should. But if you look at the last 3 times that inflation has gone up, the Federal Reserve has always raised the prime lending rate. Inflation went down, rates went down, and then we went to a recession. And so it's kind of a playbook. It's hard for the Federal Reserve to determine what's going to create a soft landing. Yeah. Because, you know, like I said, I think it's like turning an oil tank around in the ocean. It takes a long time to turn before you get going the other direction. And if you're raising those rates while you're turning, you don't know how far you have to go, and you might have overshot. So I think that's generally what has happened in the past, and probably what's going to happen this time.
So you said during the recessions, they drop the rates and then the recession hits. Now that to me sounds like, because I've always heard, except for this last time, recessions don't really hurt the housing market. Housing markets do well. Is that because those rates drop right before the recession hits?
Well, the recession hits, and then the Federal Reserve starts lowering rates in order for everything to happen at the same time. It's kind of but you're right. Housing is good through recessions, except for when housing is the one that creates the recession. Every other recession, housing has gone up. And I think a lot of people don't understand that, because I hear a lot of people in the media say, don't buy a house because rates are going to go down, there's going to be a recession, and housing prices are going to go down. Well, there's too many people, too much demand, and not enough inventory for houses to go down in price.
So I agree 1,000,000% with that. I've said it 100 times on my videos. But one of the things I also look at that I feel like it's not talked about enough is inflation happens in houses too. Mm-hmm. I mean, the dollar went up a bunch and people are complaining about the price of homes. I'm like, well, that's because each dollar is worth less money. So that has to apply to homes as well. Is that another reason why we won't see house prices drop?
Well, it's a simple supply and demand. There is inflation in everything, but when you have your demand that is so high compared to your supply, inflation is really not a determining factor, because right now we have a huge amount of pent up demand, and when rates go low, like we saw in February, people enter the market. And we're going to see another rush. And when rates got to 3% in 2020, there was a ton of people out buying houses. Well, that's going to be the same thing. And then appreciation is going to go even higher. So it's not about inflation. It's about, when there's a lot of people out in the market looking for houses because rates are low, that's going to push prices up. And it's going to be very difficult for those that wait for rates to go down to be able to buy a home, especially first-time home buyers.
Well, I think we had a lot of that. So, you look back at 2020, you have a lot of people that didn't get into the housing market because prices were too high, or they were going up too fast. They didn't want to pay over list. And then all of a sudden, like in a flash, rates jumped up. Well, then you got the people that don't want to buy because the rates are too high. And that whole time we still had one problem. There wasn't enough out there. Like, I don't know I'm not selling my house. I don't know where I'd go. So you've got all these people over the past 4 years or 3 years that haven't purchased a home, that want to purchase a home, but haven't. Plus you got all the new people coming to the market. Right. So our buyer demand pool, the minute there is a flip of that switch, is going to be, it's crazy. So when did you move to Des Moines?
April of a year ago.
Okay, so if we go back to 2006, our Des Moines market had 6,000 homes for sale. And since 2006, we added Knoxville, Newton, Marshalltown, Ames, all these other communities, I think Panora even, all these other communities. When the market got tough, they joined our MLS because they just didn't have enough. So we've added all these cities to our MLS, and we're at half the number we were at in 2006.
That's crazy.
Half the number. And I know that I've always said once we get below 3,000 listings, it's tough to find a house for your clients. It's going to get hard. Well, we're still at 3,000. We're at 3,100 right now.
Right. Well, I think one of the things that needs to happen is people that are sitting with 3% interest rates that want to buy another house, and they're, well, I don't want to make that payment. Well, you're sitting on a 3% rate and probably a lot of equity. Mm-hmm. And if you take into consideration doing like a debt consolidation purchase, where you take your car loans, all these things, pay those off with some of the equity in your home, buy the new house, then your payments, like a blended rate maybe, is like 5%. I've done some examples on my Instagram where that's exactly the situation. And then it's not as big of a leap, because you're only paying $300 to $400 more in a monthly
because you're
cash
cutting
flow.
your payments on your other stuff.
And then when rates go down, you can refinance that back into there. But you're not missing out on the opportunity to buy and have the appreciation while rates are still high. Yep. And then that gives the opportunity for people that are first-time home buyers to get into the market as well. Because there's not much inventory, and new construction is very difficult for first-time home buyers, because the cost of building is high, the cost of borrowing to build is high, the permits and everything. So we really need those people that have the first-time homes to move up. And they're afraid. The other thing they can do is there's probably equity they can take as a home equity line and put a down payment on a new house and rent their current house and have a positive rent flow that offsets their new mortgage payment. So there's a lot of ways to do it, but you don't hear anybody talking about those things about how can you get out of the house that you want to buy a new one. Your family's bigger or you're just making more money, whatever the situation is. But then that frees up some inventory on the lower end of the housing market so people can get into the first-time home.
Yeah, so like another huge stat, and this plays into that, and I hope I don't forget to bring this point up, but we had seen as high as like 60 to 65% of our inventory new construction. Mm-hmm. Right now it's dropped all the way to 45%, which is we want it down there. But the scary part of that is what you just said, these people they might want to, but they're afraid to, or they haven't made that move. They haven't been told how they can make that move. But now we're building less homes, which is, that's going to be the opportunity for the move up people. They want to buy a nice new home, right? They don't want to buy, a lot of times people sell a house because they don't want to do the projects that are needed. They don't want to buy the next house where there's going to be projects. They might want to buy a new one. The builders have pulled weight. That's a sign that the builders have pulled weight back. Mm-hmm. Which we had talked about earlier. The buyer demand's up here when they hit the market. Well, the builders, it takes 6 months to 8 months to build a house.
Right.
That's going to contribute majorly to our inventory issue once that buyer pool comes back. But there just isn't, I hear from my side of things, there's not the right house out there as much as I hear, well, we have a 2.5% interest rate.
Well, and that might be the case. I guess my perspective is, we don't get what we want. We get what's available. And in real estate, it's not necessarily, are you going to get the exact house that you want? Well, how many times do people actually get that? Unless you're building your custom.
And like people who have a house, they don't have, you know what I mean?
Well,
they don't have to buy that. If it's not the right house, a lot of people are like, then we'll just stay where we're at.
And that's always a possibility. I'm just saying that if you want to increase your net worth through real estate, sitting on the house that you have is probably not a good option. The best option you have is renting that out, getting the positive cash flow and buying the new house. And then when there's a feeding frenzy in the market, then you get appreciation on both homes.
Yep.
Or worst case scenario, you get appreciation on a higher priced home.
Yep.
So
I hear a lot from the what we'd call the national professionals on real estate. And one of the issues with inventory is just that, like people have that 2.5% rate. They don't want to list their house. They don't want to give that up. So they do exactly what you just said, and they buy something, take the equity out, buy something. Well, then this house doesn't ever come available, and it makes it so much harder for the real estate market because inventory is such a problem. Mm-hmm. And so many people don't understand that, and waiting to buy when that inventory drops is such a horrible idea because it's almost guaranteed that when rates do drop, we're going to see prices go back up.
100%. And the part of the inventory issue is it hasn't been very long that real estate investment trusts have been buying single family homes. Mm-hmm. But there's a ton of money out there in those hedge funds that are buying real estate. And if you think about this, they're borrowing money from people and paying them a lower interest rate, so their cost of funds is less. But why would they buy all this real estate if they didn't think prices were going to go up? Yeah. If they didn't think rents were going to go up? Because they understand the inventory problem. That real estate investment trusts were pretty much all commercial or agriculture or things like that. But then they realized they're missing out on a huge opportunity, and now they're coming in. I mean, there's a lot of politicians talking about we have to stop these hedge fund managers from buying up all the real estate. Well, that may be the case, but the bigger thing for me is why aren't other people taking advantage of the same thing that they are taking advantage of?
As like I said earlier, the most successful and wealthy people in our world right now own a ton of real estate.
Yeah.
And so anytime I have someone that says to me on my social platforms like, oh, never buy a house, always rent. I'm like, really? Then you don't want to live like that. You don't want to take the opportunity to grow your wealth because there are so many, like you can be so creative, and that's where you come in as a coach. you can be so creative to figure out a way to build wealth by buying homes. And it doesn't necessarily have to be rental properties.
Right.
Buying your own property and understanding how the market works. Like right now, moving out of that house and buying something that costs more money, that might seem scary, might seem like a bad idea, promise you when this thing switches, it's going to be like, oh, I'm so glad I bought it when I did.
100%. I have never had somebody come to me and say, I wish I didn't buy this house. But I've had tons of people come and say, why didn't I buy this then?
Yep.
Why didn't I make that move then? Because real estate's always going up. I have a story of my dad. It was when I was just a little kid, and we were renting, and he said, the landlord said, I'll sell this to you for $12,000. And my dad said, I'll never spend that much money on a house. Well, it's just never gonna stop. Yeah. And I have friends and family that it's like, well, real estate's too high. Compared to what? Because if you look at the graphs of real estate, it just goes like this, especially in Des Moines. And it doesn't go up very quickly, but it goes up steadily. Yep. And so right now, Des Moines is a very good place for people to come that are moving from out of state, like myself. It's about a 3% increase in Dallas County and about a 1.6% increase every year in Polk County. That's a lot of people. And those people generally are buying homes. Yep. So the people that are moving up into the age where they're buying, and it's putting a stress on them. But you have to get in order to get that equity, so then you have something to put down or have some wiggle room for the next purchase that you're thinking about buying.
And it's all about putting together a plan.
Exactly. And like we've talked before, it's not necessarily going to be easy, but the reward of actually doing it is going to be much better than waiting. Because when you wait, you don't get any net equity from rent. You just keep getting higher rent. I haven't seen rents go down hardly ever. Yeah. So that's not going to happen. So you're going to keep paying more, and you're not getting any equity position. And I get a lot of people saying, well, buying a house is just a money pit because you're going to do this and that. Comparatively speaking to your equity appreciation and your amortization gain, it's not even close. I mean, there may be some people that bought a house that's fallen down or something like that, but that's where you come in. Don't buy that house if it looks like it's going to fall down.
So another reason that may not be to buy a house, because you may not live there for a long time. Like if you got, what do you have like a certain time frame? Say, I know I'm going to get transferred for a job in 3 years or 2 years. What would be that time frame where you would say, you know what, you should probably rent?
Right now, with rates around the 7% area, it's about 3 years. About 3 years. That includes a 6% sales commission, yep, your amortization gain, and your appreciation. So your break even is about 3 years. Yep. And even in some of the scenarios that I've ran, your rent will never catch up to the mortgage payment, but you're missing out on appreciation and amortization gain, which is much, much more than the difference in your rent and your mortgage payment. Yep. And I don't think anybody really looks at that as like, well, I can rent for cheaper. Well, you can, but you missed out on 50 grand yep, by doing that.
Yeah, and typically, I mean, you can't rent for cheaper apples to apples. Like, you've got a house, you rent that same house. It's not going to, because the investor needs to make money. Right. And they have a loan on it most of the time. And if they don't have a loan, they're acting like they have a loan, and they're going to charge more than what. So yeah, you can go rent a townhome for less than you can buying this house. And that's the thing that a lot of times when I hear you can rent for less, I don't really think you can. And if you can, it's pretty rare.
Or a 2-bedroom apartment where you've got people on all sides.
Compared to a house. Well, yeah, sure, you can find something cheaper. And if it's temporary, that's fine. If you're, that's cool. But you're right. The thing that I heard, I don't know, it's just this year, I had my real estate coach, she's with the Tom Ferry Group. She says, renting a house is 1,000% rate.
Right.
Because all that money goes away. Buying a house is 6%. Which one would you rather pay?
And it's not even all that. If you get the interest deduction on your taxes, and if you look at buying an investment property, the depreciation that you write off will decrease your main income considerably to put you in a lower tax bracket. And there's just a lot of positives from real estate that, and there are not a lot of negatives. Even when rates are the way they are, and your mortgage is going to be higher than your rent or whatever, it's still a better investment by purchasing than it is from renting, because you don't gain anything, and you're paying the net worth of somebody who's you're renting from.
Yep. So you just mentioned something that brings this to my mind. We have a number of people who they're self-employed, and the name of the game of being self-employed, a little income as possible, write off as much as possible. I want to buy a house. I don't have enough income because I write off everything against it. Mm-hmm. Do you have plans that you put in place for those people to potentially be able to buy a home and get approved to buy a home without just forking out a ton of more tax money?
Yeah. And right now, most people that have done an extension are getting ready to file their taxes and their self-employment. And before you file, we need to talk, because are you missing out on an opportunity to be able to create a lot of net worth? And by limiting your tax liability, you may save $15,000, $20,000, but you give up making $50,000, 60 or however long you want.
So it's
the
about
property.
showing them the end result and how it actually might be better for you to just go ahead and.
And I have conversations with a lot of CPAs about that. It's like, I know your job is to limit their tax liability and you're really good at this, but this is what the number needs to look like for them to qualify. So how can we massage the numbers to make their tax liability as little as possible, but still have the opportunity to buy a home that over 10 years they may make, $500,000.
It seems like a really messed up system, to where the government gives you the ability to do this, but then in order for you to do this, you got to give them this.
Well, the law of unintended consequences with bureaucracies.
Yeah.
One side's making laws about taxing self-employed, and the other one's talking about how they must verify income in order to have the ability to repay on the mortgage side. But those two aren't talking. Yeah. And there's so many things, and there's bank loans and things like that we can do with people that have cash flow, but they're not 30-year fixed. They're maybe a 5-year balloon or something like that, but they're more advantageous than taking a commercial loan, which is probably a 3-year ARM or something like that. But the real thing about it's kind of like the first-time home buyers. We'll make a plan to get where you want to go, and then you decide how much pain do you want to go through to get to that plan, because the end game is going to be worth it. Yeah. The net equity and the net worth that you get is going to be worth it. It's just, are you willing to do what it takes to get in the position you can create that?
So you said, if you get an in-house loan with a bank, it might be a 5 or a 10-year loan. How long do you see that 2.5-3% rate sticking around? Like people who have those mortgages? Because I know people usually move 5 to 7 years, which means you have to get a new loan, but people also refi sometimes 2 to 3 times within that period. So the average person holds on to a loan for,
I think it's like 6-7 years now, and which is surprising because so many people have refinanced in the last few years. But with the Federal Reserve raising rates, we've also seen credit cards go up, and credit card balances have reached over $1 trillion.
I was going to ask you about that.
First time ever, and that was just about a month ago. And the payment on that debt is a lot higher. This month, student loans just started again after COVID. So there could be some people out there with a lot of monthly outgo that they haven't been used to, and using that equity in their home. And I don't really advocate to take short-term debt and make it long-term debt, unless you're going to do this by the cash flow money you save, putting it back into your house so you can reduce the number of payments.
That's the scary part, is that's how you end up with foreclosures. Because you have these new expenses, and there's going to be more new expenses, but now you're not prepared for the more new expenses because you just financed everything out to take care of those expenses that popped up. But I was going to mention, with the student loans coming, with so much credit card debt hitting right now, is that one of the reasons that we can look at it and say we're going to go into recession?
Well, I think that it's not only that, the jobs are not good. We just had the jobs number for new unemployment claims, and it was higher than expected. And tomorrow we're going to get the new jobs number.
Does that new jobs number take into account the jobs lost?
Well, the unemployment number does that, and then the new jobs is this. But the real issue is not about how many jobs are created, it's what jobs are created. And most of these jobs being created are part-time, and they're not full-time, health benefits and things like that, because there's a lot of people looking for a second income because of all these things that are happening with interest rates. So does that really count as a whole job? Not for the economy, it doesn't. Yeah. But for the Federal Reserve, they might say, well, we're still creating those jobs, so now we have to raise interest rates, because if there's more job creation, that means the economy's still doing well, and we need to tamp it down to make sure inflation goes down. And we've already seen inflation go down quite a bit. It's just a matter of, and I said something like that on social media, and I just got lambasted by people saying inflation hasn't gone down. Like, well, actually it has.
It's gone down, but where is it comparatively to like where it should be? Like, isn't it just like 1% higher still, or 2% higher than?
Well, the Federal Reserve is looking for a 2% inflation rate, and I don't know if that's attainable. Yeah. What kind of economic activity do we have to have where inflation is 2%? I don't know, but it doesn't seem to be very good, because we're still at 3.6%, something like that, and it's trending down. So, I think that at the end of the day, everybody's got to look at their best financial situation and what to do. And I'm not there to help anybody just refinance for the sake of refinancing. Yeah. If it doesn't make financial sense for you to do it, then don't do it. But if you can't make your monthly payments because of this, there's no sense in trashing your credit and going down a bad path. If you can take a debt consolidation loan and then create more equity in your home by paying it down, and then when rates go down, you may think about taking some of that equity, buying another property, or, whatever it is. But the key factor in all that is, if you have a lot of credit card debt and you pay that off, you can't go get a bunch of credit card debt, because then you're on your way to bankruptcy.
Yeah, the credit card debt is something, when that hit the $1 trillion, I was like, oh goodness. And knowing that these student loan debts are coming to, and a lot of that debt is probably in the same place.
Yeah.
I mean, our youth, like right now, I've heard, people taking part-time jobs just so they can go to concerts. And I'm like, dang it. I'm like, dang it, that's such a bad way to go.
Well, I mean, everybody's got to make the decisions they got to make. I think that the problem is that we haven't been very disciplined in our fiduciary responsibility as lenders. And in the real estate profession, I don't know if you guys even have that, but a lot of lenders will just keep refinancing people instead of saying, wait a second. Yeah, if somebody comes to me and, they have a lot of credit card debt and they want to buy a new home that's going to increase I already know that they're not making enough money. They're spending more than they're making. And if we're going to add on to that, what is that going to put them in a financial situation?
Yeah, I really cringe when someone comes in and says, this is what we can afford, and another agent's like, well, they can afford this. I'm like, what do they want to afford, and what makes sense for them to afford? Don't push people to buy something they can't afford.
Right.
So that is very tough for me to hear, because I do hear it from time to time.
Well, I would rather have them go across the street and have somebody else do the loan, because I have to look myself in the mirror. And, sometimes people do that, and sometimes we'll sit down and say, let's do this budget for 6 months, see if you can do this and pay some of this down. And then we'll look and see if you really want to go through with this or not, because you're going to put yourself in a financial situation where if you go into bankruptcy, it's not an easy road out. Yeah. And you may have the house that you want, but what are you going to do with everything else?
Yeah, well, I appreciate the coaching part of it, because having someone there that looks at a whole plan rather than just how am I going to close on this mortgage makes a big difference, and helping people understand, helping people achieve their goals, that's huge. So I really appreciate that.
Yeah. Well, I think you and I both, we want repeat and referral business.
Yes.
You don't get that from people that have declared bankruptcy or gotten foreclosed on.
No.
So putting people in the best position possible to actually take advantage of the market values. If there's not a value in the market, then don't do it. Yeah. But the data, the facts of the economics are that there is a great opportunity in the marketplace, and it's not going to be here for that long. I think middle of next year, maybe at the latest, before rates start going down and we see all that.
Do you think middle of 24?
Yeah, I think somewhere around there.
I'm thinking the same thing. Now, you said election year, but next year is the election year.
Right.
So you said the Feds don't.
Well, the Fed doesn't have to start moving rates. The rates will go down before that.
Okay.
Because as inflation trends, normally mortgage rates trend. But we've seen a lot of headwinds with the banks that are going under. There's a lot of companies like, was it Yellow Trucking that they couldn't make their monthly payments because their interest rates were going up so high. And we're seeing a lot of that.
Yeah.
And that makes bond traders very leery. So, there's a spread between mortgage-backed securities and the 10-year, and it's a large spread because people are like, well, this doesn't make sense with all this turmoil going out there. They're not going to do anything. And the Federal Reserve keeps saying, we're going to keep doing this. When the Federal Reserve finally says, we're done, you're going to see rates go down.
Yeah, and I am I crazy to think that right now with the way the economy is and with this election coming up and the current administration, am I crazy to think that they need to try and influence that to get those interest rates to drop so they can get some sort of light into the economy?
Well, I think once we see that the recession is there, it's kind of a problem for me because I was an economics major, and recession is 2/4 of negative GDP. Well, now they said that's not really what a recession is. So we've had that in the past, and generally when you look back after a year or two, they say, oh yeah, that actually was a recession. But right now they're not calling it that. But we're going to see that happen because the interest rates are so high, economic growth is almost impossible. I mean, we're seeing companies may not be firing people, but they're definitely not hiring. They're not hiring people that they have to pay benefits to and things like that. So the economy is slowing. And when that happens, obviously, gross domestic product is going to go down. And when that goes negative, we're in recession.
So the bottom line is this. If you haven't bought a house, you want to buy a house, get your ducks in order sooner than later so that you can take advantage of the opportunity to purchase a house before it's too late. And rates are going to go down eventually. So if you have to buy with a higher rate, it's okay. But get your ducks in order, get over the price. You got to get over the price because that's not going to go down. If it does, it's not going to be enough to really matter. Figure it out. Find a coach, someone who will help you get to the position to where you can buy a house.
Yeah, understand what you're going to get by buying, what it's going to cost you, what your expected return is going to be to see if it makes sense for you to do. Whether you're buying another house or buying your first house or buying your first investment property, it doesn't take that long to run all those numbers. Yeah. And then you can actually see, well, I don't believe in the appreciation rates that you're doing. Okay, well, let's put in the appreciation rate you want. I don't believe I can refinance it at that lower rate. Okay, well, then let's put the rate in that you want. I'm not going to dictate what that is just so it can look good so you can give me, we'll put whatever numbers you want in so it makes sense for you to do it. Everybody has their risk tolerance, and I'm not going to tell you, well, this is what I think you should do because I think it's right. If your risk tolerance isn't there, then you shouldn't do it. Yep. So let's make it a conservative estimate and say, well, is this going to be the return on investment going to be worth it for me? Yep. Maybe, maybe not. But if you're just sitting there not doing anything, you're going to miss out.
It's time to look at it.
Exactly.
Well, awesome. I really appreciate it, Eric. Eric Sanders, Fidelity Bank, real estate coach here in Des Moines, Iowa. If you ever need anything, you can get a hold of him. You can get a hold of me. I'll help you get in touch with him. But really appreciate your time. Special thanks to Elevated Builders for giving us a beautiful setting. And make sure you come back for the next episode of Behind the Sign.